Welcome back to Freight Waves. Time now for Heads or Tails. As Michael Rudolph joins us here, we're going to talk a little bit about third quarter GPD and also some durable goods and how things are going. Are we in headwinds or are we in tailwinds? Michael?
So this was who structured this heads or tails? I don't know. It's very binary and it loses a lot of nuance, right? But, I'm realizing that now. We saw GDP data released from the third quarter and it was stronger than expected, right? The U.S. economy is ticking along at a higher rate than previously anticipated. We saw 4.9% quarterly growth in Q3, higher than the consensus estimates of 4.5 quarterly growth. And, on the one hand, I think one could say that this kind of growth, this continued strength in the U.S. economy is concerning because the Fed might interpret this as, inflation still isn't tamed. I think the Fed is, a rational enough agent to realize this isn't sustainable. We don't need to raise rates any higher. We just need to hold them higher for longer, right? That's been the motto, stay the course. If they do raise interest rates, which I highly doubt, they will really walk on the razor's edge of a recession. But we saw the GDP data, it was good. One of the most surprising things about the release was that it was driven by personal spending, right? Consumer spending, personal consumptions. That was fairly mixed across both goods and services. Of course, in the third quarter you had Taylor Swift concerts and like Barbie and Oppenheimer and all that, right? But we also saw, spending on non-durable goods like prescription medication, and here's the reason we're talking about it today, durable goods, right? So this isn't durable goods, this is just real goods adjusted GDP. It accounts for inflation. The year-over-year change, 1% in the third quarter. Not terrible, right? It's a lot better than it could be, and if it's anywhere, above zero, that's fine by me, right? So we did see a lot of kind of strength and growth. That's good. Here's where it gets a little tricky. This is the monthly PCE data that the Fed uses to track inflation, right? The price index. But this is billions of dollars spending on durable goods. In August, right, we have $2.2 trillion, right, spending on durable goods. Now, durable goods are essential for freight economies, right? They're bulky, they take up a lot of space, they move over the roads, I think, by and large, right? Mm-hmm. Unlike consumer electronics that move over air, right? Durable goods stick to the roads. However, durable goods are, as their name implies, durable, right? So you don't need to go out and purchase them every month. Think refrigerators or washers and dryers, right? These are the kinds of things that will stick with you. If we see a lot of strength in spending in durable goods, that kind of question is, what is it going to look like tomorrow, right? If their consumers satiated on what they need to purchase, it should last them for a little while. And of course, we did see that, before the pandemic, we saw the trend line interrupted by, immediately by COVID, and then it jumped up, right? And then that just kind of kept growing, and it was more curved than a straight line, right? We're flattening out, and I'm kind of I can't help but wait for the other shoe to drop. The other person that can't help but wait for the other shoe to drop would be manufacturers, right? Now we're looking at durable goods, excluding defense spending because the government, pumps a lot of money or takes it away, according to their whims, right? But we're looking at millions of dollars of, durable goods orders from manufacturers. And we see that kind of soft curve, kind of post-pandemic, right? And we see a spike right here at the end of Q3. Again, these things don't tend to last. And we already saw one such one happen in about May or so. It does seem like a dead cat bounce potentially. It could be this kind of last hurrah of the current cycle. I'm not sure. I mean, again, durable goods is not the most reliable metric to kind of keep freight on the roads. Nevertheless, it is just essential to kind of freight volume.
Do you look at it, if you go back to the last chart there, you had, of course, this massive jump, obviously, which had stimulus money pumped into the economy and everybody bought everything and so forth. And now all of a sudden people just haven't stopped buying, correct?
That seems to be the case. And it does puzzle me because durable goods, like they're big high ticket items, sometimes require financing, right? And financing is not favorable to the consumer
right now. Or maybe you bought, say for instance, as you got your stimulus money, you bought your luxuries and now you're buying your necessities.
Right, could be the case. I mean, it's difficult to tell. I mean, of course, the third quarter is also good for durable goods spending just because, the back to school season,
right.
Whatever you need for your college kid or, boarding school kid, going off, all the furniture and all that. I mean, that does make a little bit of seasonal sense. But again, a lot of the economists who are digging into this GDP data, and I'm not an economist, just a caveat there, they're saying that, the Fed is taking this into account. They're not going to read this as a sign of like a too hot economy that they need to tame, but also that, the fourth quarter is probably going to be disappointing. So the stock markets were actually kind of up on this strong data because they said, well, they've already accounted for this strength. We don't need to, keep ourselves up at night over it because we expect to see, a softness in the fourth quarter. Lastly, we have our old, reliable revolving credit outstanding in billions of dollars. And then this green line
Here's
here,
where the money went.
Yeah, right. It's been a while, yeah. The green line here is the federal funds target rate, right? So we have, again, there's just a big, beautiful trend line up to prior to the pandemic, right? Everybody gets the stimulus money, pays off their credit cards, right? And we see that dip, and then just rapid accumulation of revolving credit like you haven't seen before. And so what I thought was interesting in comparing these two trends together, right, is because you see, all the way back to 2015, right? For the most part, the growth trend of the federal funds rate has been outpaced by revolving credit, right? And this does make a lot of sense. Rates were so low during the pandemic to incentivize spending, to kind of kickstart the economy after it was ground to a halt, right? But now, right now, we see it kind of coming into line, right? I mean, this is not, it's more of an art than a science, right? And this isn't saying that the Fed's job is done here, but it is interesting to see that finally, credit card debt accumulation rather, is kind of being tamed by this, federal funds interest rate.
So looking at it for a heads or tails perspective, what are we dealing with in terms of the economy and what the freight economy can take from it?
I mean, it's good. I mean, if we're looking in the past, obviously we have, 2020 vision of the hindsight, and it's like, okay, well, that was a good amount of durable goods that was moving over the roads. Looking to the future, again, that just doesn't inspire confidence that this is a trend that can persist for very long. And you see the consumer getting into a tight spot, not only holding on to so much credit card debt, but paying interest on it, which, interest rates are rising. This is concerning for the future. But then again, I don't want to stand here and preach doom and gloom because, the sky is falling, the sky is falling. So, I'm waiting for that other shoe to drop. I think it should pretty soon, and hopefully we will see something of a recovery in Q2 of next year, maybe Q3, for freight markets. But until then, it looks like a headwind.
It'll be tough to get through this. At least we're enjoying it for the now, but we'll see what happens, of course, next year. Michael, thanks so much for joining us here. We'll take a short break, come back with lots more Freight Waves content in just a bit.